We're taking a look at the currency market now with Michael Keenan, head of Forex Research at Standard Bank. Thanks so much, Michael, for joining us this morning. So we had the rand weaken sharply against the dollar yesterday. Some weakness still filtering through this morning, and that as the greenback rallies across the board after the Bank of Japan's move yesterday to weaken the yen. We've talked about before, the intervention like this being short-lived. What have you made of the dollar's ability to retain gains so far?
Good morning, Alishia. Yes, as we mentioned yesterday, the true asset test is whether or not this can actually be sustained by the yen. We saw the yen giving up quite a bit of ground yesterday, but that weakness has come kind of to an end now, and we've seen this kind of same price action a month or so ago, and actually the yen subsequently strengthened after that bout of intervention. So I wouldn't be surprised if we see the yen actually grinding stronger again. Of course, the dollar has benefited from that simply because it now really is one of the few safe haven currencies out there. We know that the Swiss National Bank, together with now the Bank of Japan, is actively intervening to try and stem excessive currency appreciation. So, we've got the dollar benefiting from that kind of safe haven status, as well as the lingering possibility that the ECB could actually cut interest rates later this week. We've also got still a lot of turmoil going on in Europe surrounding that debt crisis. So the dollar really one of the true blue safe haven currencies left.
And overall, we know that the rand is at the mercy of that fickle global sentiment that's persisted over the past 2 months. Any surprise that the data we saw filter through on home ground yesterday, that being the trade number where we recorded a surplus of 2.5 billion rand in September, was not enough to boost the rand, Michael?
Yeah, I think you're right. I think that international developments are already dictating rand proceedings at this stage, and probably are likely to do so for the remainder of this year. If we look at the trade data yesterday, we shouldn't get too carried away or too optimistic, simply because if we look at kind of on a 3-month rolling average basis, we're still headed for, we're still in trade deficit territory, and we're probably going to post a trade deficit for the third quarter of this year. It looks like our current account deficit in turn is going to be widening. As a percentage of GDP, that ratio will look even worse because now growth is slowing. So I think on the trade channel side, not looking good. Sure, exports were quite robust in yesterday's reading, but that partly is a function of a strong rand price of commodities. Ultimately, we've got to be very careful that this global slowdown doesn't actually affect the actual volume levels of those exports, and I think that's in the pipeline. We saw this morning some very soft manufacturing data out of China. So I think our trading partner countries are under the whip, and that could hurt our exports. While on the import side, I think once again South Africa can't run away from the fact that we are kind of price inelastic to these import prices. The rand now weaker, it's going to increase our import bill, especially things like oil. So I'm still very concerned about the trade channel. As I said yesterday, we saw the rand weakening initially in recent months on the back of the portfolio outflows, but I think the second leg of rand depreciation will come through from the export channel and the trade channel.
Looking at the data calendar for today, Michael, we've got a PMI in focus. It's been in contraction for 2 consecutive months, and many saying if it stays below that break-even point of 50, it will keep hopes alive for another rate cut. What are you anticipating there?
Yeah, I think the risk is definitely that we see a poor reading today from the manufacturing sector. As I said just now, we've got our trading partner countries and under pressure. Demand's not forthcoming abroad, it's not forthcoming domestically. So we're going to be watching that index very closely. Things like the employment index as well will be key. We've seen other employment data out as well today, and all of that, of course, just keeps alive hopes of an interest rate cut from the MPC later this month. At the moment, the FRA curve is more or less unchanged in its view, still basically a 50-50 call priced in by that market. But I think there's definitely a risk that the SARB actually does pull the trigger. It's not our base case scenario, but if there's more weak growth figures out, from the local front, we know the international front is weak. The Reserve Bank could well, inject a bit more liquidity into this market.